Welcome to this Fund Manager Q&A brought to you by Livewire Markets. My name is Bella Kidman and today I'm joined by Matt Reynolds, Investment Director at Capital Group. Thanks for joining me today, Matt.
Good morning, it's great to be here.
With COVID-19 sparking a structural shift towards an increase in digital usage, what would you say that you're looking for in a company, and do you remain bullish or bearish on this trend long term?
Well, we're looking for companies that have attractive business models or that are able to tap into secular growth opportunities and have the desirable characteristics of experienced management teams, robust balance sheets, high returns on capital and strong cash flows. So we see these as what we call quality growth companies, and they have strong relative resilience in the current volatile markets. Some of the digital companies display these characteristics and have benefited from the strengthening of a tailwind created by how people work and spend their leisure time as a result of COVID-19. And when we look longer term, we think that many of these changes in activity will stick and that the growth trajectory for some of these companies has actually accelerated.
So looking forward, would you say that you're bullish or you're bearish?
We'd say we're pretty confident, and we think that there is potential for further growth going ahead in these companies.
And what would you say some of the key risks to that thesis are?
Well, the obvious risk is that this strengthening of the tailwind, that it dissipates in some way, or it dissipates more than expected, or evaporates for some businesses and for consumers as they come out of the pandemic. And so our analysis is really focused on understanding those trends that are sustainable and those activities that even if they retreat to a higher level than they were before the crisis. I mean, as a stock picking investor, the other key risk, obviously, is if a management misexecutes their strategy in some way, and that damages our long-term thesis for the investment.
So specifically in the technology sector at the moment, there are very expensive valuations. So how would you justify that at the moment?
So in our view, the growth will continue, or growth companies will continue to command a higher premium relative to other investment opportunities. And this is for a couple of reasons. One, we think that true growth opportunities are fewer in a world of lower GDP growth rates. They'll be sought out more frequently. And secondly, in an era of ultra low interest rates, this reduces the discount rate that we use to evaluate stocks. And so this allows investors to extend their timeframes, to increase their focal length, if you like, and this tends to favour growth opportunities. We also see some businesses, such as the subscriptions-based businesses, as having the potential to cater for very large and often global addressable markets. And this enhances their potential to achieve long-term compounding of their growth. And I suppose as a key final point, as stock pickers, we only really invest in the companies where we see the potential for long-term adequate returns. And that's not the case for every tech stock. And indeed, there are some tech stocks that should be avoided merely because they are expensive, even with a long-term perspective. So
we've spoken about the increase in digital usage as a shift, consequential of COVID-19. Another current structural shift that investors are starting to notice is obviously the move towards 5G. So who would you pinpoint as the biggest winners of the rollout of 5G, and why are they going to be the winners?
So one way to think about 5G is to talk about 5G in a very simple framework, and that'll help answer the question. So we think of 5G as having three levels. The first level are the broad providers or telecoms companies. The second level are the enablers and the infrastructure providers that make 5G work. And the third level being users and the industries that will adopt 5G as part of their business models. At the moment, we see the most opportunities being in that second level, being in the enablers, and also to some degree in the third level being the user industries. But that's for the longer term. The enablers, though, are the owners of key infrastructure in the 5G ecosystem. And these are things like cell tower operators, the high-end chip makers, component makers, and data centers. And that's where we see a terrific opportunity for growth going forward as 5G is deployed over the next several years. That third level, the users of 5G services, that will come over time, and that's really seen through the prism of cost savings. So potential costs can be taken out of manufacturing and other industries as they avail themselves of some of the benefits of 5G, such as its very low latency and its very high capacity. And that's particularly the case, for example, when they deploy machine type communications within those business models.
Yeah, it's really interesting. Another sector that's obviously been in the limelight throughout COVID-19 is healthcare. What trends would you say that you're looking for specifically in the healthcare sector? And do you think that these trends will be maintained post-COVID-19, or they're just all the rage at the moment?
So from a healthcare point of view, we see a potential very significant increase in the number of novel or new drug targets as a result of innovations that we're seeing in cell and gene therapy. We're seeing the use of big data, machine learning, and artificial intelligence within the healthcare sector, particularly as these new treatments are designed to speed up trials, the trials and testing of new therapies. And so we see a lot of growth ahead in the healthcare sector. We see also more investment coming into public health infrastructure. And we're seeing really brand new COVID vaccine inspired, in some ways, collaboration across companies as they seek out these new compounds. And we think these are going to be very important trends over the next 3 to 5 years. We think these trends certainly outlast the current COVID-19 environment.
Right, so it's not so much a COVID-19 thing, it's generally the healthcare sector's taking off at the moment.
That's right.
So another sector, like technology, it looks attractive and it has a runway for long-term growth. While Capital Group is a bottom-up investor, are there some market sectors that you think you might be taking a relatively lower exposure to over the medium term?
Yeah, so it's a great question. So we analyse and research all sectors on a global basis, but there are certainly some sectors where we have a comparatively low level of investment at the moment compared to, say, the broader market or the index weighting, for example. And so the three sectors where we have very low levels of investment at the moment are the banks globally, because we see net interest margins continuing to decline and traditional profit pools being picked off by new competitors. We also have comparatively small investments in the energy sector and energy companies. Many of the competitive advantages that the energy companies enjoyed have been eroded, and now they're merely commodity price takers. And finally, the telecoms operators, which I touched on earlier, and I left out of our 5G comments because we're not heavy investors in the telecommunications companies, and we're concerned at the heavy capex that is ahead of those telecommunications companies as they go about deploying 5G networks.
So we've spoken obviously about a lot of different structural shifts, both as a consequence of COVID-19 and not. But can you provide an example of a company or several companies potentially that you think will continue to perform following COVID-19, and potentially shed some insight as to why that's different from a company that won't continue to perform after COVID-19?
Yeah, sure. So a couple of the companies that we believe could continue to benefit from the shifts in behavior that we're seeing at the moment in a number of sectors. Good examples would be PayPal and MasterCard, where we see electronic transactions continuing to grow and replace the use of cash. I'm sure all of us are tapping even for small items like coffees and small purchases now, whereas previously we used to use cash, and that's not going to go away quickly. Amazon and Microsoft are good examples of companies that continue to benefit from the growth in cloud computing. And cloud computing's addressable market, we think, is very much larger than what the current size of the market is. And Netflix is a good example of a company that should continue to benefit from changing consumer habits, as some consumers permanently changed their viewing habits to do more online And so whilst there might have been a rush of subscribers into it initially, we think a number of those subscribers will stick, and that habits will change over time to more viewing online. And again, the addressable market for viewing media online is very much larger than what the current market is at the moment. So what makes these companies different to many others is that their current market shares in their area are actually relatively small in comparison to the potential market that they can address over time. And a growing market share can, we think, potentially prove a very strong tailwind for future results. And as results improve, obviously, that should be reflected in the valuation of the companies.
Thanks very much for joining us today.